Thank you. This is joint work with Jihoon Han and Bruce Meyer at the University of Chicago, and we'd like to thank Jim and Jan and Justin for including us in this very important conference. While we're thanking people, let me see if I can, for some reason I can't advance my slides right now. While we're thanking people, we should thank our funders. The National Science Foundation provided support for this, as well as the Wilson Sheehan Lab for Economic Opportunities at Notre Dame, and several foundations that support the Comprehensive Income Dataset Project at the University of Chicago. As motivation for this project, I wanted to quickly describe some quite sudden and significant changes that have occurred, many of which have already been discussed in the first session, but we've obviously seen a sharp decline in economic activity in recent months. If you just look at what's happened to employment as reported by the monthly CPS, you can see this sharp decline. In April, the decline of 14% is the largest decline on record. At the same time, we've seen an unprecedented government response. Just as one example, one of the largest programs was the stimulus payments or the economic impact payments. They provide $1,200 to individuals with income below $75,000 of income, and $2,400 to married couples below $150,000, plus $500 for each kid. Since April 1st, we've given out over 159 million payments and totaling more than $257 billion. In addition, there's been a somewhat dramatic expansion in unemployment insurance. This is increases in claims for regular UI, as well as the PUA program, or Pandemic Unemployment Assistance, which is expansion in the eligibility of UI to those who might otherwise not be eligible, like the self-employed, gig economy workers, et cetera. And if you look at the initial claims, just in recent months, since mid-March, we've had more than 49 million claims for unemployment insurance. So this program has expanded considerably as well. Taken together, it's natural to ask the question, what is the net effect of these dramatic disruptions on family income? And the problem with answering that question is we don't get household survey data on income until September of 2021, at least for the official source of income statistics and poverty statistics, the annual and social economic supplement to the CPS. We don't get that until really it's too late to inform policymakers and key policy decisions. We do get a lot of, as we've already seen, a lot of information on aggregate or using administrative data, but it's important to have near real-time information on questions like what is the impact of the pandemic on the poor and other parts of the income distribution, and are some demographic groups disproportionately affected? And the survey data are going to help us go a long ways towards addressing these kinds of questions. So what we do is we use family income as measured in the monthly CPS. And this is on that survey, which is our source of the monthly unemployment statistics. They also ask a question about, it's a global question of total cash income from all sources, from all members of the family over the past 12 months. And what we do is take that measure of 12 months of income and compare it to the official poverty threshold for that family of a particular size and composition. And we construct poverty estimates before and after the start of the pandemic. In addition to looking at poverty, it's important to look at other further up the income distribution. So we examine several different percentiles further up the distribution. And we consider the contribution that the key government programs played on the results that we'll show you. So even though we're on Zoom, I have a sense I can read your minds on what you're thinking, and you're probably asking, wait, aren't these the consumption guys? And it's true that in a series of papers, we have argued that consumption is a better measure of well-being than income at the bottom. But to be clear, we've never said you shouldn't look at income. We think both income and consumption are important, and perhaps consumption doesn't get the attention that it deserves. And it is true that there are concerns about underreporting of income, and those concerns remain. In past work, we've shown that that's particularly important when looking at long-term changes in economic well-being. It's less clear how critical that is for the very short-term changes, the month-to-month changes that we're considering in this paper. So before I show you what we actually find, I think it's helpful to think about what we would expect to find given that current environment that I showed you. So I'm going to do this by way of three particular examples. So three scenarios. In all of these scenarios, think of a family of four with just one worker, and their earnings accounts for all of family income. And then for each of these scenarios, the worker experiences an unemployment spell at the very beginning of April, and following that collects the stimulus payment and unemployment insurance. And so the difference across the three scenarios are the different pre-separation income levels. I'll show you what happens for somebody at the 60 percentile of the poverty line. That's about working at the minimum wage full-time, full year, as well as a family pre-separation income at 75% of the federal poverty line and 90% of the federal poverty line. So if you look at what happens in April they receive the economic impact payments. They also receive unemployment insurance, which we're specifying as half of pre-separation earnings. And they also receive PUC. Now, PUC is pandemic unemployment compensation. That's the $600 top off per week in unemployment insurance payments. If you couple these different payments together, it's more than 5 times pre-separation monthly income for that family at 60% of the poverty line. So some people have said, well, instead of looking at 12-month income compared to poverty, you should be looking at monthly poverty rates. If we did that, given the size of these transfers, nobody would be poor. But because we're looking at a 12-month window, it includes these payments as well as the prior 11 months, where they were below the poverty line. By the time you look at May, where they no longer have the economic impact payments in that month in May, but it's still in their 12-month window, they're still receiving the $600 bonus per week plus unemployment insurance. That exceeds their pre-separation earnings, so income is rising. What you can see in May is that for really up to about any family that pre-separation was within 70% of the federal poverty line would be lifted above poverty under this scenario. When the PUC payments are due to expire at the end of July, now monthly income is below the pre-separation level. Incomes are falling, but because we're looking at a 12-month window, they're still above the poverty line for a reasonable stretch. And then you see incomes fall sharply as the economic impact payment falls out of the window. And the key takeaway here is, given the way we measure poverty, it's reasonable to expect that these federal programs could have a very significant effect at lifting a number of families above the poverty line. Now, before I show you results, let's do a little bit of benchmarking on the monthly CPS income. Because it's not widely used, it's helpful to see how does it compare to other income sources that we think are reasonably high quality and have been used in a large amount of economic research on income. So if you estimate poverty rates in the ASEC, the Annual Social and Economic Survey, in the CPS, that's the official source of poverty statistics in the US, and compare it to our estimates from the monthly CPS, what you see is that the poverty rates, well, let me make 2 points. One is that the level of poverty in the monthly CPS is higher, which suggests that the global income question is capturing less income than is the ASEC, which asks about 25 specific components of income. The second point, though, is that the changes over time are fairly consistent, that we see the rises and falls in poverty in both sources. If we were to turn to another source of income, the Consumer Expenditure Survey, that asks income on a quarterly basis using a 12-month reference period, the levels and changes line up really closely. So together, this gives us some degree of confidence that what we're measuring with income in the monthly CPS is quite consistent with other sources that have been used much more frequently. Okay, all that leads up to what we find. What I report, our main results here for poverty in the 25th percentile, I report the estimates of poverty using the monthly CPS for 2020, for the months that we have data. And what you see, if you combine January and February estimates and compare it to April and May, we see a decline as reported in the far right column of 2.3 percentage points, or just over 20%. And that difference is statistically significant. As we look further up the distribution, here I show you the 25th percentile scaled to a family of 4. What we find is between those two periods, an increase of about 11% of $5,000 at the 25th percentile. We looked further up the distribution and we see evidence of increases in income through the 75th percentile, although the rises decline as we move up the income distribution. In addition, we looked at differences across many different demographic groups, as well as across states based on their experience with COVID-related deaths and their policies. And I report the change from the pre-period to the post-period here. And a couple of points to make here is that one, we really see evidence of a decline in poverty across many different demographic groups. You might point out that it looks like the other race group is experiencing more of a decline, say, than either Blacks or whites. The other race group is majority is Asian. And that is true, but we did look and we can't reject the hypothesis that any of these declines are the same across the subgroups. So we don't have enough precision to say those things definitively. And it also doesn't look like there are noticeable differences across states, whether you split them by death rates or various policies. So I think it's important to think about the role that government policy played here. So we're going to do something that's a little similar to what you saw earlier. What I'm reporting here in the green bars is the poverty rates for January and May that you saw earlier. I've blown this up not to exaggerate our differences, but so that you can see the actual changes. And then the blue bars are counterfactual estimates for poverty in May. And it turns out in the monthly CPS, we have really good data on whom is likely to receive these payments. So we impute economic impact payments in UI. We have information on family size and composition and whether or not they're unemployed. And when we look at the total sum of our imputed values, they match the government aggregates really closely. And quickly, what this shows is that we've seen, if you take out all of the government programs in the first blue bar, those programs combined explain more than all of the decline in poverty that we find. Poverty would have risen slightly if we excluded those programs. And amongst the programs, the one that had the largest effect was the economic impact payments, where you see if you take out the economic impact payments, it really cuts down the decline in poverty that we find. The economic impact payments explain more than half of the decline that we find, with the other half being accounted for by UI programs, either combined all, and then here we show just the ones that were new as a result of the CARES Act. So taking all of this, we should probably put it in the context of some other evidence, and this includes evidence that we've seen just in the last session. But as you saw in some of the figures in the last session, disposable income grew significantly in April. We don't have the May numbers yet. So that's consistent with the rise in income we're finding from the survey data. But what we're showing is that it's not necessarily isolated at the top of the distribution. We're seeing rises at the bottom as well. Also, there's evidence on spending behavior that's already been talked about. If you look at credit records, there's an initial decline that we see a rebound, especially for low-income zip codes. And then, as we just saw, the microdata for low-income households show a rebound in spending and a large increase in savings, and particularly for low-income households. And moreover, this early spending decline cannot be entirely explained by labor market disruptions. What coupled with our evidence suggests is that the spending decline is not because of a decline in income. It's also, we want to put this in the context of other evidence on economic hardship or economic well-being, and there's some evidence that hardship has increased, and you're going to hear more about that momentarily. But we should emphasize that we don't think that that evidence is inconsistent with necessarily with what we're finding. I think you could both could be true. So to kind of wrap that up and elaborate on that, it's really good news to know that poverty, or to find out that poverty has not fallen, has not risen. That it in fact has fallen, and that incomes have risen. But it's important to caveat that this is a very short-run finding, and as I showed earlier, this could actually change as we move further on post-pandemic. It's also important to point out that increase in income don't address all the challenges that people face, and so we don't want to necessarily say that people are better off. There are important health concerns and concerns about disruptions in social interactions, as people can't go out and interact with others, or it's more challenging. And there are real concerns about the future, and for that perhaps explains at least some of the declines in spending that we're seeing. And so this asks the important question of what's going to happen over a longer period of time. And although I can't tell you that now, the good news is that the monthly CPS is available, new data becomes available every month. And so in 3 weeks, we will give you an update to what we find, and hopefully that'll provide a clearer picture of the economic impact of the pandemic.
Thanks, Jim. That was very clear. The next paper is going to be presented by Diane Schanzenbach, Social Safety Net in the Wake of COVID-19.
Fantastic. Thank you so much. Today, I'll summarize our work, joint with Marion Bittler and Hilary Hoynes, on how the social safety net for low-income families in the U.S. is responding during the COVID-19 crisis. Of course, in response to the unprecedented COVID-19 shock, Congress has greatly increased spending to individuals, with over $400 billion paid cumulatively to families out by June 19th, according to the daily Treasury statements. So relief payments, here shown in green, make up a little less than half of the total and started in mid to late April. UI expansions in orange make up about 51% of that total new spending. This includes regular UI payments, the $600 weekly top-up, and then also the payments through this new PUA program that extends benefits to workers who are self-employed or have little work history. These UI payments, as you can see in orange, have steadily increased across the weeks. The 2% of the increased payments in blue have run through the Department of Agriculture. This includes normal increases in SNAP participation that we see during economic downturns. It also includes a new provision that raises all payments to the minimum benefit level, and that impacts 60% of caseloads and brings in another $160 in those families per month. And also flowing through this line is a new program called the Pandemic EBT program, which provides food benefits for families who lost access to free or reduced price meals when their schools closed. Despite these payments, measures of distress are very elevated. In this graph, we monitor food insecurity, which is a survey measure designed to assess whether families have enough money to support adequate food consumption. In normal times, it's measured with a battery of questions asking respondents to what extent they agree with statements such as this: our food just didn't last and we didn't have enough money to get more. Or to what extent households report that adults or children skipped meals, cut size of meals, or went for a day without eating, specifically because there wasn't enough money for food. Subsets of these questions have been asked in both the Census Household Pulse Survey and the COVID Impact Survey, which allow us to monitor it in real time. In companion work that we describe in our paper, we assess how to make the old and new surveys as comparable as possible, and you see our preferred method here. In general, in the annual time series that we show here back to 2012, you can see there are two downward sloping lines that hover around 10%. Orange for households with children and blue overall. Since food insecurity is an economic measure, of course it varies with the unemployment rate. And so using that relationship, we can project food insecurity out to February 2020 at the economy's peak, shown here in the square markers. Food insecurity was 8.5% overall and 9.4% among households with kids. During COVID-19, surveys indicate that food insecurity has doubled overall to 23%, and almost all of this increase can be explained by the increase in the unemployment rate after adjusting for misclassification. Food insecurity has also tripled among families with children, who've been hit harder across many dimensions. Many are in single mother families, and they certainly lost school meals. Other measures of economic distress are also dramatically elevated. On the left here, we show rates of receiving food in an emergency food pantry, and those have spiked. This is consistent with reports from Feeding America, which is the umbrella organization of food pantries, whose members have reported a near doubling in numbers served each month. On the right are measures of mental health distress, such as feeling down, depressed, or hopeless, or nervous, anxious, or worried. And these rates have doubled relative to the last pre-COVID comparable study. Of course, this raises the question, why do we see so much need despite so much spending? And we think there's three reasons. The first is the timing of payments have been delayed. The second is outside of unemployment insurance, the magnitude of these payments has been relatively modest. And third, we'll show you that we think that there's evidence that we should be concerned about potential lack of coverage. So to start, thinking about timing, many of these payments came with delays, in part because they came with setting up new programs. For PUA, which is the new unemployment insurance payments that go to workers who are self-employed or who fail the work history test, and these are likely serving disproportionately low-income workers that we're interested in here, by May 1st, states representing just over half of the workforce had paid any PUA continuing claims. At the beginning of June, still over 10% of the population lived in states that hadn't made any payments. On the right, the new PBEBT program was quicker to pay families already on SNAP, but it was slow overall. By May 1st, we estimate that only 10% of payments had been dispersed. It's of course important to remind you that many families, especially low-income ones, lack savings and access to credit. So these delays in payments will understandably come with real hardship. But despite the suffering, also note that when the payments are eventually made, this is going to make them whole in terms of the annual poverty measure, which treats income today as the same as income with a 3-month delay, as long as it's in the same calendar year. Indeed, it is perfectly consistent to see both increased need and little change in poverty rates. So second, we must frankly praise Congress for taking action to quickly disperse increased money through SNAP. This happened much faster as measured by months since the business cycle peak during COVID, as illustrated here by the solid lines, than the Great Recession, which is illustrated by the dotted lines. These benefits, though, are relatively modest to individual households, about $40 a week, and they only went to the subset of current SNAP participants who are already relatively better off. So next, we're concerned that many low-income unemployed are not getting unemployment insurance. And I am very much aware that this statement is going to go against some very strongly held priors of many of you. So let me walk through the evidence of why we think this might be cause for concern. So here is step one. Many low-income workers are usually ineligible for unemployment insurance. Some of this was relaxed by the CARES Act, which I'll discuss next. This graph shows simulated usual UI eligibility in 2019 for all workers in blue and those earning below poverty in yellow. Normally, fewer low-income workers are eligible for UI. You can see here it's 63%. On the other side of the graph, 14% of these low-income workers are ineligible because they're undocumented, and that's been left unchanged during this crisis. 17% of low-income workers are usually ineligible due to failing the work history test. These are individuals with uneven earnings and spotty employment histories. 7% are ineligible due to being self-employed. So this combined 24% of low-income workers, highlighted in the orange box, may have seen their UI eligibility increase due to the CARES Act under the new PUA program. The second piece of evidence is that there is usually a gradient in UI receipt by education level. This graph shows the receipt of UI among the short-term unemployed at the trough of the Great Recession. About 30% of unemployed workers with a low education level received UI, compared to about half of the workers with high levels of education. So now we can come to the contemporaneous survey data from the COVID impact survey, which was collected at the beginning of June. This shows reported UI receipt in the prior week among furloughed workers by education level. At the beginning of June, fewer workers with low education report receiving UI. Some of you might find these levels shocking, but we're particularly interested in the evidence on the gradient here. So to be sure, like all data, this survey is not perfect. There's a modest sample size, the questions have limitations, which we discuss in the paper, and the response rate is low. And this is absolutely true for all the survey results that we report throughout this paper that were collected during the COVID-19 era. Now that stated, there are many aspects of the data that line up with our expectations. For example, as shown here, more furloughed workers report receiving UI over time across survey weeks, which is consistent with our expectations as state backlogs clear. Also, unemployed workers receiving UI report having lower rates of food insecurity, which also lines up with my priors. What we'd like to do is turn to more data sources, in particular administrative data during this time period. Regrettably, timely administrative data that break down receipt by income or education level are extremely hard to come by right now. The single exception we've found is from the California Policy Lab's regular reports on the UI administrative data from California. This is one piece of administrative evidence available. This is the only one we found by education group, and it shows the share of initial claims paid from March 15th through May 9th. A lower share of initial claims made by those with low education end up being paid. Next, we can look at administrative data on continuing claims, which we have not been able to disaggregate by income or education level. This also suggests incomplete coverage. 50% of the adjusted unemployment level in April is covered by UI continuing claims, and just over 60% in May. In sum, we read the whole of the evidence as raising legitimate concerns that UI is not, or maybe not yet, reaching as many unemployed workers with low income or low education levels. Time will tell if expansions to the PUA system will help, but it's very important and needs continued monitoring as more data become available. So taking a step back and moving to the conclusion, we need to make a broader point that we develop more in the paper, which is we have moved in the last 25 years to a work-based safety net that focuses on boosting low wages and rewarding work. But there is little in the current safety net that is automatically counter-cyclical. We have built a safety net that works for us in good times, but not for bad ones. It needs policy attention to expand it even during normal economic downturns, let alone this one. So what do we recommend doing? Well, first, we think that there's evidence that great need persists despite the heroic actions that have been taken already. The evidence is imperfect for sure, but given what we know from the literature about the long-term impacts on children being exposed to commonplace economic shocks, we think that overreacting here will surely be less costly than underreacting. And things will be absolutely worse if we let the current policies expire. So what to do with SNAP? Because of limitations in the broader safety net, we currently are asking SNAP to do much more during recessions. Of course, there's a limit to how much we can do through SNAP because of its limited fungibility, but we think we can surely provide more right now. We think that moving everyone to receiving the maximum benefits, which is worth about $170 per person per month, was a really smart move by Congress, and that should be extended at least until we're out of the worst of this recession. Maximum benefits should also be extended by at least 15% across the board. And this, we argue, is good policy in every recession. We also think we should keep paying out these PEBT benefits to families with kids on school meals over the summer because it serves a broader group than those just receiving SNAP. It's going to provide liquidity and protection over the summer, but importantly, it also means if we're shutting down schools again in the fall, the program will remain in place. Finally, regular UI payments just won't be enough in many states when the $600 go away, and we endorsed the proposal by Jason Furman and co-authors last week to continue a $200 subsidy. Further, it is extremely important to understand, to continue and to monitor and understand to what extent UI is serving disadvantaged workers. We may need to make more payments outside of the UI system made if people are falling through these cracks, potentially relief payments that are more targeted than the first round of relief. And we've got some thoughts on how to do that targeting. And certainly when everything has calmed down a bit, we need to more carefully assess structural reforms to the UI system so we can provide better insurance to low-income workers, which will be key to sustaining a work-based safety net during normal economic recessions. Thanks.
Thanks very much. Our discussant for both papers is Abby Wozniak.
Okay, thanks everyone. A thumbs up if you can hear me.
Yep, you're good.
All right, and thumbs up if you can see my slides advance.
You're good.
That was a new one I learned last week. So thanks Jim and Jan for inviting me to discuss these two really exciting papers. I'm just going to highlight the Federal Reserve disclaimer we've already seen. So I'm going to just heighten a bit what I think we heard from Jonathan, and I'm going to say that I've been really pleased to read two great papers, but I'm going to highlight that I think that within them they contain one big puzzle, and it's been exciting as I've read the different versions of the paper to see authors moving to really try to answer and address that puzzle, but I think we have a little bit of a ways to go. So let me say a bit more about that. So Hohnmeyer and Sullivan, we saw a really exciting, I think, exercise in improving the real-time measurement that we can do using data actually that we already have in the CPS monthly interviews. They find really strongly, I think strongly is a fair word here, declining poverty rates from February to May of this year, suggesting substantial poverty buffering of emergency income support programs. And the contrast here is with previous cyclical changes, we would have expected an increase in poverty rates. And in particular, the paper shows what that looked like in the Great Recession. Bittler, Hoynes, and Schanzenbach, I think, are telling what sounds like a fairly different story. They document sharply rising financial insecurity and significant increases in unease among households, particularly with lower earning adults, across really a variety of dimensions, but especially food insecurity. And this suggests the kind of body of evidence that they're able to assemble a larger and more acute increase in insecurity based on similar measures than we're seeing even over the entirety of the Great Recession. So what you really have in these two papers is a really different relationship to the cycle than we saw in the last recession based on which indicator it is that they're using. So I just want to say a bit more in terms of details on each of the efforts before I go into trying to talk about how we should interpret this set of findings together. Hohnmeyer and Sullivan are looking at income measured as self-reported annual total income from cash sources over the prior 12 months. So this is asking folks to give their income on a 12-month basis. They're surveyed in week 3 of each month, and that's going to come up in a timeline in a second. They established that this measure, although it hasn't been the focus of a lot of previous research or analysis or tracking or almost anything, nevertheless has a strong relationship to other income and poverty measures that we can compare it to using its previous iterations. A question I had, just as an aside, is this true in changes as well as levels? And it looked to me like the relationship maybe differed in expansions versus recessions, so exploring that would be helpful. Their basic findings are that poverty fell by 0.7 percentage points from November of 2019 to February. So we were on the end of our expansion, it turns out, and we saw a kind of decline of that magnitude over a period of 4 months. Then in a 1-month period, at the very beginning of the shutdown, poverty fell by the same amount. and then by 1.6 percentage points from March to April, the very large decline, and then another 0.1 percentage points from April to May, for a total of 2.3 percentage points decline. Again, that timing I think is going to be important for thinking about this measure, and I'll come back to that. For context, the decline from the Great Recession peak to 2019 was about 4 percentage points. So we've seen basically about a half the change that we saw in the most recent expansion occur in a period of 3 months or less. Income is rising kind of throughout the distribution, but most predominantly in the lower parts. And perfect compliance estimates of the role of the federal benefit expansions can fully account for these changes in their estimates. By perfect compliance, I mean this is what everyone would get if they got every dollar of benefits through unemployment and pandemic assistance that they were eligible for based on their characteristics in the data. So I want to kind of underscore that because that links to, I think, some of the differences that the second paper is finding. So finally, and I wanted to draw this out because I think this is the strongest statement of their findings, they conclude that the increase in deprivation is not due to overall income loss, but rather to other disruptions. So Bittler, Hoynes, and Schanzenbach are taking a really different tack in a sense. The first paper focuses on a single estimate of income. The second paper focuses on really a suite of indicators. So they use a large range of data to examine changes in household well-being and economic security. And they're exploring the connections between this suite of measures and the extent of benefits receipt and disbursement. So they're really interested in moving away from this kind of perfect compliance or estimated benefit receipt that we saw in the first session to how many dollars actually got in folks' pockets and at what time. The findings here are, like I mentioned, a global rise in distress characterized by rising unemployment, particularly among already lower earnings groups, rising food insecurity, and declining mental health. What they find in terms of food insecurity is that it's largely in line with previous cyclical relationships. And this, I think, is also an interesting comparison with the first paper, in that the cycle here really provides a guide. So you can then take the information that you have from other indicators, for example, like UI, which they do in the second half of their paper, and ask what we would expect to see in terms of actual benefit receipt, kind of under this assumption that past cycles are a reasonable guide. And I think the evidence from the first paper would suggest that based on the massive changes in government programs, the past cycle is not always a guide. So again, that becomes another fault line between the papers. Can we use past cyclical estimates to extrapolate to our current situation and what it will look like, or should we not, or where should the caution be with that? So how do we interpret what I see as a bit of a tension in these findings? And again, I'm really glad to see that as the papers have evolved, the authors, both teams are really working to try to address this themselves as well. So the papers are looking, I think it helps to step back and say the papers are looking at signals of some kind of general household level well-being concept. And like all signals, these are going to be somewhat imperfect. You can refine that a bit to say, if we had to put them under one umbrella, both papers are interested in financial security. Can households reliably cover their current, potentially that's important, that word, current essential expenses for food, shelter, and daily needs? So if we think of this as a situation where we have signals, the signals are giving us somewhat different pictures. And so in that situation, I think there are three options to try to understand what's going on. The first is that one of the signals is wrong, or possibly that both are wrong, but that one of the signals is wrong and that it's biased to a wrong sign extent. So it's telling us things are moving one direction and maybe in reality, they are not moving in that direction. Another option is that both are right, but they're representative of different US households that are experiencing these changes and support somewhat differently. And I will be candid that this was my prior after reading the first iteration of the papers. And then the second iteration of the papers, after responding to some questions about that, I have less weight on that. I'll come back to that. And finally, I think a third option is that these signals represent different facets of financial security, and these facets are changing in different ways. And I think that to the extent that they agree on this, they didn't have to answer it specifically. I think the teams are converging potentially on this third option. But let's think about these a little more closely. So I wanted to come to a timeline. I thought the slides that Diane showed on that were really helpful. I've broken it down in the following way, looking at the week by week events that happened between the beginning of March and the end of May. And this kind of shows you where the information that the two papers are using comes from in this timeline. I've highlighted the CPS survey weeks that the first team is using in green, and purple is really the beginning. It would carry through the entire kind of subsequent set of weeks of many of the indicators that the second team is using. I've also highlighted where those programs are starting, as was done in the second presentation. And what I want to highlight is that a first piece of evidence in the first paper comes from this third week of March survey, in which CARES was still being debated. We'd had 3 million initial unemployment insurance claims. CARES had not yet passed. And of course, none of the benefit support payments had begun. So that is that decline that I talked about between February and March in poverty rates of 0.7 percentage points is coming from that first green survey. The big decline comes from the difference between the first and the second week, highlighted at the bottom of the grayed out portion. You can see that in that period, these payment programs did begin, but roughly, I think we could say only about half to 2/3 of payments had really gone out by the time of that second CPS survey. So I highlight that timeline because I think it helps think about, could one of these signals have have a wrong sign? And I want to talk about the first team's signal first. So I think they do a really admirable job of showing that the measure they're using has good consistency with other previous measures of poverty, both in the CPS and outside of the CPS. But I do think that change that's picked up in March raises some questions. And I would kind of counter, I think, an argument they have that a value to this is that the same question has been asked in the same survey for a long period of time. We're running into that same situation with the employed not at work example that many of us are correcting for in unemployment rate calculations. It's the same question, but jumping ahead to my bottom point, people are answering it a little bit differently than they did in the past. And so I want to kind of throw out an alternative possibility. So one possibility is people are not answering the question quite correctly and there's more bias in it. Another possibility is a specific kind of bias, which is that folks might be retiming or anticipating income and putting that in their kind of March response, or maybe even their April response, as they answer that question. Overall, it will tend to give us the right picture of poverty over a couple month period, but it might not be right month to month. So understanding more about that, I think, would be really helpful. In terms of the other measures that the second team is using, again, it's nice that this is a suite of measures. They tend to align with one another, so that tends to make us comfortable, but I think the first team is showing similar evidence for their signal. There are many ways to compare these measures across a few different sources, and in general, the direction and general magnitude align. But as I think Diane was alluding to, the exact magnitude is often different by maybe more than we would like. That could be related to who these surveys are reaching. And that's kind of the point, that sometimes the levels differ from survey to survey. So it makes it hard to know precisely how big the actual change was. The direction seems to be consistent. How big was it? Obviously, that's a really important question. The caveat to both of these is really that we've never surveyed in a pandemic before. And so heightened general anxiety might affect how people answer these questions. It may also be the case, particularly in the income question, that folks are treating permanent and transitory income differently. And so transitory income may be reflected in their income reports. They may discount it when they're kind of trying to anticipate their food insecurity, gauge their mental health, or think about their expectations for spending going forward. I'm going to speed up very quickly. As I mentioned, my view is that both papers are looking at very broad swaths of the population. I don't actually think they're getting different stories because they are looking at different groups of the population, but that could be explored more. I do think it's worth thinking about a kind of third option, which is that the concept is different. Again, these are different signals of different facets of financial insecurity moving in different directions. I think an important follow-up to that is for both teams to really look a bit more at the evidence on questions around $400 emergency expenses. Those have been asked in a couple of these real-time surveys. They're comparable over time. And that evidence, which I would think would be consistent with cash inflows, nevertheless suggests rising financial insecurity. So I think focusing on that question to think more about exactly what the concept is picking picking up as useful. And so finally, I'm just going to conclude with what I think are the joint lessons coming out of these two papers. I do think, fortunately, in spite of some tension, there's a lot of overlap in what they would suggest for our next steps. Very briefly, they suggest that we should address known dimensions of distress with auto-stabilized packages, with supports that only end when the pandemic has fully concluded. We also need to continue to monitor persistence in the changes to annual income. Some of this will erode, and we're also not quite sure really if all of it has gotten to folks yet. So monitoring those things are incredibly important and adjusting policies as needed. And then finally, this didn't get discussed, but monitoring price increases because of the substantial changes to the economy that the pandemic has generated. It may be affecting sectors that are relevant for overall well-being, but are not showing up in any of the other indicators already covered by these two teams. Thanks so much.
Okay, thanks. So let's go to general questions. Steve Davis has his hands up.
Great, thanks. Really interesting papers. I was struck and disconcerted by the troubling rise in food insecurity. And it's especially troubling in light of the massive income support programs that have been provided. And if those numbers turn out to be correct, I see it as a real indictment of how policy intentions get implemented on the ground in the UI system and the SNAP program in general. And I'd love to see if you have thoughts about that, but I think the economics profession in general hasn't devoted enough attention to the execution of policy intentions. And I thought I heard you say that, we should wait till things settle down to figure that out. That's not my view. Okay, maybe I misunderstood. We ought to get on that right away so that the next time we roll out more income support programs, that they actually are more effective in addressing the most extreme forms of deprivation. And I read the data, your evidence is saying they failed on that score in a pretty big way.
Jason Furman.
My question actually is very related to Steve's, which is, to what degree is the problem the execution of policy, so people are eligible for programs and they're not getting them, versus the design of the policy, which is that people aren't eligible for programs because, for example, they're undocumented, and so that policy needs to change. And to that end, to what degree is the policy priority, continuing things, expanding amounts of money, versus a real focus on changing eligibility? I then had a separate, unrelated question, which is one interpretation one hears of the lines of food banks is that they're a form of precautionary savings, that even if you could afford the food now, you want to save more money up just in case you can't later. And also the opportunity cost of time is lower now, so why not wait on one of these incredibly long lines one sees? Do we have any evidence on whether those two interpretations, have any merit?
There were also some questions in the Q&A that the authors might want to address when they respond, in particular about what's driving the large numbers of unemployed workers who did not receive unemployment benefits according to the survey results. So if you could dig into that a little bit more, I think that'd be helpful. There were a couple of questions in that direction.
Okay. Oh, okay. Jay Shambaugh.
Thanks. These are fascinating, and that was a great discussion by Abby. I did have questions for the first group on some of the imputed benefits issues, and in particular around how they dealt with immigration. The immigrants weren't eligible for the stimulus checks at all. Anyone and in fact, I think even if you had an immigrant as part of your tax household, you weren't eligible. And so I just didn't know how that was handled with a lot of people who just wouldn't have gotten the checks. And similarly, then undocumented not being eligible for the checks at all, but also not being eligible for UI. And so it made me wonder, especially there was a comment, I think in some of, either in the text or the appendix, talking about some of the biases offsetting. And I'm just wondering if the biases that you're dealing with, the the people not getting the checks being biased towards the people who are close to the poverty line or far below it. And similarly with the UI, and that I think some of the stuff Diane was showing made it look like, disproportionate UI non-receipt being at the very low income range. And so that makes me wonder just if there are a lot of people that you're imputing income to from the benefits that aren't getting it. And then the other question was for Diane on how much is food availability and food price an issue with some of the food insecurity stuff, at least as the household member going to the grocery store for a while? Like I noticed a lot of cheaper staples were just gone, and a lot of things that were SNAP eligible were sold out and things like that. And to what extent that was a problem?
Okay, thanks. So seeing no more hands raised, I think we're going to turn it back to the authors. So authors of the first paper.
It's okay if I go, Jim?
Yeah, please.
Okay. So let me emphasize that there are lots of reasons why food insecurity could have gone up besides a decline in income. We saw that there was a big decline in spending. There was a huge increase in uncertainty and worries about what was going to happen in the future. There also is a lot of evidence that the food insecurity measure has problems. It has very peculiar time series patterns, and it doesn't accord well with other measures of well-being. Also on the reports of not receiving unemployment insurance, I think we should stop using self-reports of unemployment insurance receipt. We have overwhelming evidence that people underreport their receipt. If you look at the total weighted reports of receipt in the CPS, which is a survey that carefully looks at their reports of receipt of benefits and has been around for 70 years. More than 40% of those receiving unemployment benefits don't report. So, and it's gotten a lot worse over time. So we really should not make anything from self-reports of unemployment insurance receipt. In terms of how we do our calculations in the simulations, there are some conflicting biases. We take everyone who is unemployed in May to receive unemployment insurance benefits, and we use the number of weeks reported to calculate the number of weeks of receipt. Now, that's going to miss people who had unemployment spells but got a job, and we know there were a lot of those because BLS reported that despite increasing a lot of new initial claims, unemployment fell in the last month. So we know that there's been a fair amount of churning. So those are going to be people that we miss using just who's unemployed in May. And I think in terms of other biases, we shouldn't make a lot out of the unauthorized. The latest Pew estimates are that they're less than 3% of the population. Now, in terms of policy, we may want directed policy at that group, though not going to happen in the near future. But in terms of explaining overall patterns, it's just not a big enough group to explain anything here. And also in terms of policy going forward, it seems like there's a lot of sensible concern about ramp up by the states in terms of not being able to get benefits out. But that's really an important water under the bridge problem, not something that really is affecting what policy should be going forward. I think it calls for more targeted policies towards those who really are being currently missed.
Okay, thanks. Hillary, or who's in the second paper?
I'm going to start out the response. Thanks, Jim. Thank you very much, Abby. Really appreciate the thoughtful comments and thinking about how to weave this together to try to see what kind of picture we can conclude from it. Let me start out by just kind of addressing a couple of threads that I see, both that came up through the Q&A chat feature, as well as the comments that were just raised. And I think that part of the two very broad questions are, number one, who is left behind and why? And to what extent are those that are left behind due to, as Jason raised, ineligibility versus implementation? And that obviously has very important impacts for what we would expect going forward and what we might recommend as policy. So let me sort of try to take bites of those two very important questions. First of all, Shamba mentioned an important feature that in our short time, Diane didn't have a time to mention, and that is the fact that the relief payments, which are clearly very central, did not go out to anyone where there was an I-10 filer in the household. And so there's a large class of individuals that are categorically ineligible for those benefits under current statutes. So that's one element, as well as what Diane talked about in terms of ineligibility for UI categorically by documentation status. So there are a lot of groups that are left behind through eligibility. Second, implementation, of course, matters dramatically. A couple of thoughts on that. To get back to the relief payments, as I'm sure many of you know, the relief payments were sent out automatically to all individuals who had filed taxes in 2018 or 2019, as well as augmented by individuals who were receiving benefits through Social Security or veterans payments. So estimates by the Center for Budget and Policy Priorities have that leaves behind 12 million eligible individual payments that are largely the most disadvantaged Americans who are eligible but not getting automatic payments. Those would be, a large share of those folks would be on SNAP or on Medicaid or very low earners in addition. And so that requires application, that requires getting over more administrative hurdles to get. And so it's a very clear recommendation, I think, around implementation is that the more automation we can do in providing these benefits to the eligible population, the more effective they're going to be. And then in addition to that, we know that there's been a lot of, on this question of, Peter Ganong asked this in the Q&A, which I think, the bottom line is I think time will tell. But Peter's question is, how much of the UI slowdown is a slowdown versus a sort of ineligibility? And I think, as Diane showed, both through administrative records as well as the survey data, the UI receipt is going up. So clearly part of this is a timing issue, though timing is still very important for people living on the edge. But all we can say is that the best administrative data we have that looks at heterogeneity the California Policy Labs data only on initial applications and their conversion to payments shows that we have the same gradients across disadvantaged groups that we've seen in prior recessions. And how much of that has to do with the challenges of getting online and satisfying all of the requirements about reporting, I think is a picture that is not clear at this point. But all we can say is these gradients, which have been persistent across all economic cycles in America, are still present with the best data we have today. So I'll leave it at that.
Okay, thanks, everybody.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.